Larry Fink's journey into finance wasn't a straight path, it began with an interest in politics. Raised in a rapidly changing America, he enrolled at UCLA in the late 1960s to study political science, drawn to the idea of shaping policy and influencing society. But as he neared graduation, he realized that his ambitions weren't best served in the unpredictable world of politics. Instead, he pivoted to business, earning an MBA from UCLA's Anderson School of Management. This shift would set him on a path that would ultimately change the financial world. His first major opportunity came at First Boston, a prestigious investment bank known for its aggressive expansion into new financial markets. This was the 1970s, a time when the bond market was starting to gain traction as a major player in finance. At the time, stocks were still the dominant force, but bonds were becoming more attractive due to their stability and predictable returns. Fink, recognizing the potential in this emerging sector, became one of the first traders at First Boston to focus on mortgage-backed securities, a new and complex financial instrument that would soon transform Wall Street. Fink wasn't just trading bonds, he was helping to create an entirely new market. In the early days, mortgage-backed securities, MBS, were an untested concept. Traditionally, banks would issue home loans and hold them on their books until borrowers repaid them. But Fink saw an opportunity. What if these loans could be bundled together, turned into securities, and sold to investors? This would allow banks to free up capital and issue more loans, while investors could earn steady returns from the interest payments made by homeowners. The timing of this innovation couldn't have been better. The Reagan administration was actively deregulating financial markets, creating an environment ripe for experimentation. First Boston quickly became one of the leading institutions in the MBS market, and Fink was at the center of it all. He developed sophisticated models to price these securities, making them more attractive to large institutional investors like pension funds and insurance companies. As his reputation grew, so did his responsibilities. He quickly climbed the corporate ladder, becoming the youngest department manager in First Boston's history. The firm entrusted him with massive amounts of capital, and he delivered impressive returns year after year. By the early 1980s, he was one of the bank's most valuable players, generating hundreds of millions in profit. Wall Street was entering a golden age, and Fink was among its rising stars. But success has a way of blinding even the sharpest minds. The more money he made, the more risks he took. In the world of high finance, calculated bets are necessary, but unchecked confidence can be dangerous. Fink, like many of his peers, believed that his models could accurately predict market movements. He trusted his ability to hedge against losses, assuming that certain economic events were unlikely to occur. This assumption would prove fatal. In 1986, disaster struck. A single miscalculated trade wiped out $100 million in just one quarter, erasing years of gains. The loss was staggering, not just in monetary terms, but in what it signified. In an industry where perception is everything, Fink went from being a genius to a liability overnight. Despite his past successes, Wall Street has little patience for failure. He wasn't fired, but he was sidelined. The same colleagues who once sought his advice now avoided him. Meetings became awkward, phone calls went unanswered, and his influence within First Boston evaporated. It was a quiet exile, one that left him with a harsh truth: no matter how high you climb, one mistake can bring everything crashing down. With his reputation in ruins, finding a new job proved impossible. No major investment bank wanted to hire someone with a $100 million loss on their record. At just 36 years old, a career that had seemed unstoppable was suddenly over. For the first time in his life, he had no clear direction. But Fink was not the kind of man to accept defeat. While many in his position would have faded into obscurity, he spent months reflecting on what went wrong. He realized that his mistake wasn't simply a bad trade, it was a failure of risk management. First Boston, like many banks, had been playing a high-stakes game without fully understanding the dangers involved. Trades were made based on gut instinct and incomplete data, with little regard for worst-case scenarios. If he was ever going to rebuild his career, it wouldn't be by returning to the old system. He needed to create something different, a firm that wouldn't just trade assets but would fundamentally change how risk was understood and managed. But to do that, he needed investors. And in the world of finance, money follows confidence. With his reputation still tainted, convincing anyone to back him would be the greatest challenge of his life. Starting over in finance isn't easy, especially when your last big move ended in disaster. Larry Fink knew that. The industry he had once dominated now viewed him as a cautionary tale, a reminder that even the brightest minds could make costly mistakes. But failure, for him, wasn't an end, it was an education. He had spent years navigating markets, pushing boundaries, and watching the system reward risk-takers without fully understanding the dangers they were embracing. That, he realized, was the problem he could solve. He didn't just want to return to finance. He wanted to build a firm that did things differently. A firm where risk wasn't an afterthought but the foundation of every decision. But ideas alone don't get you far in Wall Street. He needed money. He needed backing. And with his name still carrying the stain of his past losses, securing investors was going to be an uphill battle. It took time, but eventually, he found the one man willing to bet on him, Steve Schwarzman, the ambitious co-founder of Blackstone. Unlike the established banking giants that had turned their backs on Fink, Schwarzman was still building his own empire. Blackstone had made its name in private equity, but Schwarzman had bigger ambitions. He wanted to expand, and he saw in Fink not just a talented trader, but someone who could bring an entirely new dimension to his firm. The two struck a deal. Blackstone would provide the seed capital, $5 million, to start a new venture under its umbrella. In 1988, Blackstone Financial Management was born. It was small, scrappy, and entirely focused on a single mission, understanding risk better than anyone else. Fink assembled a team of like-minded analysts and traders, individuals who, like him, had seen firsthand how a lack of oversight could turn a winning strategy into a disaster. They weren't interested in making the biggest trades or chasing the hottest trends. Instead, they built their edge on data, using technology to analyze investments with a level of detail that most firms ignored. At a time when Wall Street was still largely driven by intuition and experience, Fink and his team were taking a different approach. They relied on algorithms, statistical models, and a rigorous system for evaluating every investment. The goal wasn't just to make money, it was to ensure that no major losses ever caught them off guard again. The strategy paid off almost immediately. Within 5 years, the firm had grown its assets under management to $8 billion, a staggering leap from its humble beginnings. Clients weren't just investing with them for returns, they were drawn to their ability to break down risk in ways that no one else could. But success brings complications. As Blackstone Financial Management grew, so did Fink's ambitions. He wanted to expand beyond fixed-income investments, to create a full-scale asset management firm that could compete with the biggest names in finance. That meant hiring more talent, developing new financial products, and most importantly, giving employees a stake in the company's success. This was where the friction with Blackstone began. Fink believed that in order to attract the best minds in the industry, the firm needed to offer stock options, something that would make top executives feel like true owners rather than just employees. Schwartzman, however, had no interest in diluting Blackstone's control. To him, giving up equity was giving up power. And he wasn't willing to do that. The disagreement wasn't just about ownership. It was a clash of philosophies. Schwartzman was a private equity man, focused on buyouts and deals. Fink was a trader, obsessed with building a firm that would last beyond individual transactions. The more they argued, the clearer it became that their visions for the company were incompatible. Fink had a choice: stay under Blackstone's control and accept its limitations, or break away entirely. He chose the latter. But leaving wasn't simple. Blackstone still owned a majority stake in the company, meaning Fink couldn't just walk away. He had to find a buyer willing to purchase Blackstone's share. Enter PNC Bank, a regional financial institution with ambitions of its own. In the early 1990s, PNC was on an acquisition spree, scooping up firms to expand its footprint in the wealth management sector. When Fink approached them with the opportunity to buy out Blackstone's stake, they didn't hesitate. The deal was massive. Blackstone had originally invested just $5 million, but now, only 5 years later, it was walking away with hundreds of millions. Schwartzman, despite his reluctance to let go, couldn't ignore the numbers. He agreed to sell. And just like that, Fink was free. Blackstone Financial Management was rebranded as BlackRock, an independent company with a clear mission: to become the most sophisticated asset management firm in the world. The break was more than just a financial transaction, it was the start of a new era. BlackRock was no longer just a division of a private equity firm, it was its own entity, with full control over its future. And under Fink's leadership, it would grow into something far larger than anyone could have imagined. Breaking free from Blackstone was a victory, but it was also a gamble. Larry Fink had won his independence, yet BlackRock was still a relatively small player in a financial world dominated by giants. Managing $8 billion in fixed income assets was impressive, but in an industry where firms controlled hundreds of billions, it wasn't enough. If BlackRock was going to survive and thrive, it needed an edge. Fink knew that expanding blindly wouldn't work. Competing on sheer size wasn't an option, so he had to find a way to make BlackRock indispensable. The answer, as it turned out, was buried in complexity. Wall Street was awash with financial products that few truly understood. Mortgage-backed securities had become more intricate, and new types of bonds and derivatives were emerging faster than investors could keep up with. Even seasoned institutions struggled to fully grasp the risks they were taking on. That's where BlackRock came in. Rather than just managing assets, the firm positioned itself as a problem solver, an expert in untangling the mess that others didn't know how to handle. Its focus on risk analysis became its greatest strength. And then, in the early 1990s, BlackRock got the opportunity to prove itself on a massive scale. The moment came when General Electric found itself sitting on a ticking financial time bomb. Through a series of acquisitions, GE had inherited a $10 billion portfolio of collateralized mortgage obligations, complex, highly structured bonds that could be incredibly lucrative but also dangerously volatile. The problem? Nobody at GE fully understood what they had bought. These assets were dense, opaque, and difficult to price. If handled incorrectly, they could turn into a major loss. GE's legendary CEO, Jack Welch, had built his empire on ruthless efficiency. He didn't like messes, and this portfolio was exactly that. He needed a firm that could make sense of it, repackage it, and, ideally, turn it into something that wouldn't weigh GE down. BlackRock, with its growing reputation in risk analysis, got the call. Fink and his team worked relentlessly, dissecting every layer of the portfolio, breaking it down into more manageable components, and restructuring it in a way that made sense for the market. In simple terms, they took a chaotic pile of financial instruments and transformed it into something investors would actually want to buy. The process wasn't just about salvaging value, it was about proving that BlackRock understood the risks of modern finance better than anyone else. When the restructuring was complete, GE had successfully offloaded its troubled assets with minimal losses. It was a defining moment for BlackRock. The firm hadn't just managed money, it had fixed a problem that even one of the world's most powerful corporations couldn't handle. Word spread quickly. In an industry where trust is everything, BlackRock had just built an unshakable reputation as the go-to firm for risk analysis. Other financial institutions took notice, and soon, more companies were coming to Fink for help navigating their most complex investments. The success with GE catapulted BlackRock to new heights. By the mid-90s, its assets under management had skyrocketed from $8 billion to over $46 billion. But Fink wasn't satisfied. He saw a much bigger opportunity: technology. Risk wasn't just about understanding the numbers, it was about having the right tools to track and manage them. At a time when most asset managers still relied on outdated systems, BlackRock invested heavily in developing cutting-edge software to monitor financial markets in real time. This wasn't just an internal tool, it became a product. BlackRock started offering its proprietary risk management software to other institutions, giving banks, pension funds, and governments access to the same analytics that had made BlackRock so successful. Clients weren't just hiring the firm for its asset management expertise, they were paying for its ability to see risks that others missed. Then came the next major leap. In 1995, PNC, BlackRock's parent company, decided to merge its wealth management division with BlackRock, pushing the firm's assets to $154 billion. The scale was unprecedented, but Fink was already thinking beyond traditional asset management. For him, this wasn't just about growing BlackRock's size. It was about positioning it as an essential pillar of global finance, an entity so deeply embedded in risk management and investment strategy that no major financial institution could afford to ignore it. The firm wasn't just managing money anymore, it was becoming the infrastructure of modern finance itself. And yet, even as BlackRock rose, Fink knew that the financial world was heading toward dangerous territory. The same innovations that had made firms like his successful were also making markets more fragile. Financial engineering had created powerful new tools, but it had also built a system that was growing increasingly interconnected, and increasingly vulnerable. The question wasn't if a crisis would come. It was when. And Fink was determined to make sure that when it did, BlackRock wouldn't just survive, it would come out stronger than ever. By the mid-2000s, BlackRock was no longer just an ambitious asset manager, it was a dominant force in global finance. With its expertise in risk analysis and its growing influence over institutional investments, the firm had woven itself deep into the fabric of Wall Street. But what Larry Fink saw on the horizon wasn't just opportunity, it was danger. Decades of financial innovation had created a system so complex that even the institutions driving it didn't fully grasp the risks they were taking. And when the cracks finally gave way, BlackRock would be one of the few firms positioned not just to survive, but to shape the future of finance itself. The warning signs had been there for years. Investment banks had become addicted to securitization, repackaging mortgages and other loans into products that were widely traded but poorly understood. The mortgage-backed securities market that Fink had helped pioneer had grown into a monstrous web of financial derivatives, with layers of complexity that obscured the real level of risk. By the time subprime lending flooded the system, the entire market was built on an illusion. Loans were being issued to people who couldn't repay them, and those loans were being bundled into securities that were then rated as safe investments. In 2007, the first signs of collapse appeared. The housing bubble, inflated by years of reckless lending, began to burst. Mortgage defaults surged. The intricate financial structures that had spread risk across the system started unraveling. The banks that had eagerly bought and sold these securities suddenly found themselves holding assets they couldn't value, let alone sell. Panic set in, and the liquidity that kept financial markets moving started to dry up. As institutions scrambled to contain the damage, BlackRock was already positioned as the firm best equipped to handle the crisis.